Welcome to the Startup Competitors Podcast, where we talk with early-stage entrepreneurs to understand what information they use to inform product roadmap, strategy, and market differentiation.
Hey there. Welcome to the podcast. Today we are talking with Wes Barton, who's the co-founder and managing partner of Third Prime. That's at thirdprime.vc. This is an awesome conversation. Wes is a farmer turned lawyer turned investor, started angel investing in 2010, raised his first fund in 2016. And now Third Prime is, sounds like, based on the podcast, you'll hear some of this, killing it out in New York. And just really enjoyed this conversation. We talk a little bit about how Wes got started. We talk a lot about what it looks like to run a deal process through Third Prime, some of the things that they're looking for with entrepreneurs and companies, and kind of the do's and don'ts. And some of it's a little bit technical, some of it's not. I hope that you enjoy that. Hopefully, if you're listening to this, you know that that's a little bit about what I do. But just a great conversation. Hopefully, you'll find a lot of value in it. If you do, hit Wes up on Twitter. He leaves his Twitter handle in the end. I think it's, from memory, farmer_VC. And give him some feedback, letting him know what you thought. That would mean a lot to me, and I think it'd mean a lot to him. Thanks so much for listening. If you happen to be looking for a way to ignite your brand, spark some sales, or maybe just fire up your team, branded merchandise might be the way to do that. You can learn more about different items that are available to put your logo on at fuelmerchandise.com. It can be simple startup swag, corporate gifts, anything you're looking for. You can find it at fuelmerchandise.com. Mention Startup Competitors, get 10% off your first order. Welcome to the podcast. Today we have Wes Barton, who's the co-founder and managing partner of Third Prime. Wes, welcome.
Hey, Mike. Glad to be here. Thanks for having me on.
Why don't we start with a quick pitch for Third Prime? Tell us what you guys do.
Yeah, sure. So, Third Prime, we're a venture capital firm based out of New York City. We are focused on, the earliest stages. So we invest, primarily at the seed stage, although we do some Series A, investing as well. What that means to folks that might not be as familiar with the nomenclature. We're typically investing in companies that are quite young. In most cases, they will be, generating some revenue that's, probably going to be, fairly nominal. And, they're probably looking to raise, anywhere from $2 to $5 million at the time of our investment. We are a lead investor. And, so what that means is, we're going to execute a term sheet, likely put in, at least half the round. Sometimes, could be, sort of 75% of the round. Look to build a good syndicate alongside us that can also help, help the company. We're probably going to end up taking a board seat and then doing all we can to get, aligned with the company to achieve, milestones and so forth that need to be accomplished over the next 12 to 24 months before we, raise the next round, or the company would raise the next round of capital. As far as what type of companies we invest in, Mike, we are industry agnostic. Really what we're looking for, fantastic entrepreneurs, large addressable markets, differentiated products and services that we think, have unique attributes that are going to allow the company to achieve meaningful market share. While we are agnostic to industry, we've done a meaningful amount of investing in fintech. We've also done, a fair amount in prop tech and increasingly healthcare as well.
I love it. It's a great place to start. I'm super curious, would love to hear maybe just super quick, a little bit about your background and why did you decide to do Third Prime? Yeah,
Mike, it's funny. I like to joke that I'm the first farmer turned venture capitalist. I grew up on a little farm in rural Kentucky. You might notice my southern accent here. Despite living in New York 20 years, I've maintained it. I started actually as a lawyer. So that's what took me to New York. I was an M&A lawyer, practicing with Skadden Arps in the city for several years, representing a lot of private equity funds and, hedge funds. Ended up leaving the law and started investing in the public markets and sort of later stage private markets, working with a hedge fund and private equity fund for a while. And, while doing, that investing, really recognized that I thought that there was a great opportunity, to back, entrepreneurs at the earliest stages. I could also see as an asset class, I thought venture capital was really going to be increasingly attracting capital. Saw technology, sort of moving from sort of just, sort of vertical, sort of industry to something that was much more pervasive and sort of going horizontal and impacting, all industries. So it felt like sort of investing in technology and that type of disruption was going to be, something that had a lot of legs to it and, could be quite lucrative. And so, started effectively angel investing back in 2010. Had developed a nice track record along with my partner who launched Third Prime with me. We parlayed that angel track record into Third Prime, and today Third Prime's got about $100 million under management. We've invested in 35 companies.
All right. I have so many questions based on that. That was awesome. Thank you. I am also very, very minor hobby farmer.
Oh, wow.
So that's super interesting. I am not a lawyer, but I am also an angel investor. So I'm just take my own little guilty pleasure moment here. Can you talk a little bit about that transition from just angel investing in a couple of deals to $100 million fund? Like, how does that, maybe in the big Duplo blocks version, how does that unfold?
So to be honest, Mike, started sort of investing off my own balance sheet just because I felt like there was, sort of great, asymmetric risk reward in some of these opportunities that I was seeing. Cobbled together special purpose vehicles. So the first deal we did, put $800,000 into it. So it was, some of my money and just sort of friends and family and folks that thought that it was an interesting, sort of investment opportunity. Really, had good fortune on that first investment. That $800,000 became nearly $8 million in 2.5 years. So sort of great cash on cash return. And didn't know if, frankly, I was lucky or good at that point, but certainly wanted to keep trying, and so took the proceeds from that first investment, rolled them into several other investments that did quite well. And really, sort of leverage that track record to show that my partner and I, we could source deals, we could diligence deals. We're basically, sort of investing behind, sort of the same, hypothesis we have today that, folks need more than capital. The good opportunities, don't have, much trouble attracting capital. It's sort of, capital that can, bring more to the table. And so, we were taking board seats. We're really trying to work, hard on behalf of those companies to help them achieve success. And, we sort of acted as angel investors about 5 years. And in 2016, when we raised our first fund, those entrepreneurs acted as great champions of ours in the fundraising process. Those folks that had come into those, individual deals, obviously, were sort of, foundational investors for us, made a lot of, important introductions for us. And, sort of the rest is history. But, it's no shortcuts that I've found here. Obviously you got to just sort of chip away at it. You really have to, try to do best to sort of, for the entrepreneurs, for, sort of the folks that you're investing in money to try to report, often and honestly, with respect to what's going right and, in some cases, what's not going so right, and, sort of building that trust. And, we feel like, we were fortunate to sort of wade into this market, pretty early. It was very sort of different landscape, frankly, in 2010 than it is today. There are a lot more angel investors out there. There are a lot more venture firms being formed today. The landscape's quite competitive. And so, like I said, it's really what else can you bring to the table? We did a deal or signed a term sheet just, a couple of weeks ago. It was highly competitive. And, fortunately, we were able to introduce that entrepreneur to a lot of other entrepreneurs we'd worked with. And, sort of we're able to sort of beat out some other fantastic firms there to win that deal. But it's an exciting landscape. There's tremendous opportunity, but, increasingly there's a lot of competition as well.
And way at the start of that, you said special purpose vehicle. I'm assuming that's just a simple LLC that you put together for friends and family, no 2 and 20 or anything on top of it, just a way to get everybody on the cap table, right? Is that right?
You got that right. Yeah, exactly. I mean, early on, it's just trying to, pull the capital together. Certainly didn't have, an ability at that point to take management fees or promote on it, as you alluded to. We did start promoting those investors after, we kind of got into our 4th or 5th deal. We starting to be able to show, hey, look, we can actually make you a lot of money here, and people are sort of willing to, to pay us fees to go out and sort of do the work. But, earliest days, absolutely. It was just, trying to get, people that would come alongside us, put some capital, into a deal and let us start doing some work and trying to build that track record.
Awesome. Thank you. I appreciate that diversion. Okay. So, let's go back to Third Prime today. I'd love to hear, what is an entrepreneur's experience? So from the moment they kind of reach out to you to the point that you decide to fund and put money in their bank account, can you walk us through that at a high level?
Yeah, for sure. So, while look, every process is going to be, slightly different. I'll give you sort of the broad strokes the way most of them go. First and foremost, we try to be respectful of the entrepreneurs. We recognize that fundraising is diverting them from the job of running the business, which most of these entrepreneurs are working just incredible hours, 7 days a week in many cases, and so it's hard even when you're not fundraising. So first off, we're going to try to be respectful of that process, and if we look at just hundreds of deals every year, and as I mentioned before, we've only invested in 35 companies going all the way back to 2010. So most most companies we see are not going to get sort of an investment from Third Prime. So we do our best to try to quickly get to a no, and not sort of string folks along to the extent that that we realize that it's unlikely to result in an investment. So there are a lot of quick no's. I would say maybe it's 90% of the sort of deals will sort of get cut after that first phone call. So that's the way it usually starts. An entrepreneur will email us an investor deck and probably a synopsis of sort of what they're doing. To the extent that we think it could be a fit, we'll take that phone call. Usually those are going to be 30, 45 minutes just to kind of get an overview of the entrepreneur and sort of their vision, the product, the market. Sort of walking you through that funnel. Sorry, I'm jumping around here. We get a lot of emails, thousands of emails sort of coming down, our collective inboxes. I'd say we're probably going to end up doing something, like 300 calls, initial calls each year. I would say that, first call moves into a second call, probably, 20% of the time. Once we do that second call, it's usually going to be.
Wait, all right, stop, because I know we'll never get back to it. So I apologize. But what is going to get me eliminated in that first call? I'm just not a good. Turns out I'm not at the right state. I'm not far enough along. I'm not in the right industry. Maybe like what's my disqualification criteria?
Yeah, great question. So we're trying not to even get you on the phone, Mike, if we feel like that there's not going to be a fit. So usually that introductory email that you might send to us, we're going to get a sense of okay, are you generating revenue? Are you too early? Are you too late? Are you in an industry that we've actually got some interest in? Does it look like that there could be something here that could result in an investment? So we're trying to create as much of a screen as we can, before even jumping on the phone. We don't want to waste your time. We don't want to waste our own. So now we get to the phone call, right? What we're doing there is really trying to understand, are you a missionary or are you a mercenary, right? That is sort of one of the phrases you think about, right? It's very, very difficult to be an entrepreneur. I just said it's competitive in venture capital. It's even more competitive right out there as an entrepreneur. Very, very few sort of landscapes that you don't have just sort of multiple folks sort of vying for the prize. And they're easier ways to make money than to become an entrepreneur and try to start a company. So we really want to try to dial in on what's driving that entrepreneur. Is it something that's just keeping them up at night? There's just they can't get away from the fact that they've got to solve this problem. They've got to provide this service for some underserved community or whatever it might be. So at the outset, we're really trying to just vet that entrepreneur, and a lot of it is okay. Do they have just tremendous passion for this problem? Second to that is, do they have a unique vision? Right. So a lot of people that are willing to sort of work hard and really have a burning desire, but do you have some insight? Do you have some type of founder market fit that would suggest that you might be able to crack the code in a way that just frankly others haven't? So that's something that we're spending time on. Is there charisma? Are you eloquent? Can you sort of tell the story? Because not only are you going to have to convince us to make an investment, but you're going to have to recruit a team. You're going to have to sell to customers. That entrepreneur early on is wearing multiple hats, and so if they aren't going to be the one that's out there sort of doing the recruiting because they don't have tremendous charisma or can't sell the customer, is there a co-founder perhaps that's going to be able to sort of serve in that role? So we look at the entirety of the founding team to sort of see if they're checking sort of all the requisite boxes, if you will. Once we get comfortable around that entrepreneur, then we'll start to look at from the market. Is it sizable? As a venture capitalist, we're looking to invest in businesses that if all goes right, they can be worth billions of dollars. So if we feel like that there's a lower ceiling on something, maybe the market is just smaller, or sort of the serviceable market is just, of a nature that you're probably not going to be able to get, much, beyond $100 million, sort of in equity value, it's probably going to be a pretty quick pass for us.
How often is that the case? I'm curious because I get the feeling, maybe this isn't true. I feel like we see more smaller deals like that, maybe located where we are in the Midwest, than I feel like you might see out where you are. But maybe that's just a false assumption, and that's the case everywhere because it's really hard to get to $1 billion outcomes. And but is that a common disqualification criteria, or is it not so much?
It is, Mike. But at the same time, we've sort of done this long enough now to recognize that sort of companies sort of twist and turn, and what might start as a smaller market is actually just serving as a wedge into larger markets. So we try to be thoughtful about it and not just sort of come at it myopically. We recognize that there's going to be a lot that that can change. I think, frankly, it's probably not as much of a hard cut and eliminate as many companies as you might think. Again, and perhaps it's probably because we're giving them the benefit of the doubt that these markets could evolve, and just because a market might not be large today, there could be some sort of tailwinds or sort of macro factors going on that could really sort of impact the size of that market in 5 to 10 years. Which again, when we invest, it's not uncommon for us to have 7, 8, 9, 10-year holds, on these investments. So, not that we can predict the future, but we try to be thoughtful about that. So that's, for us, frankly, that's not sort of the cut around sort of that addressable market as often as you might think.
Got it. Perfect. Keep going.
Yeah. So then we're going to, I mentioned team, sort of the TAM, the total addressable market. We're also going to start to think about traction. And so there have been cases where we're effectively investing in a guy or gal and an idea sort of on the back of a napkin, but that's certainly an anomaly. Usually for us, they're going to, like I said, have some revenue. There's going to be some product market fit. We really believe that, that there are a lot of folks out there that can tell a great story, that are really, really smart, that have, sort of a big vision, but, can you execute, right? It's, a lot of times, it's, you find folks that just sort of can't push the product out the door, right? Or can't get that customer sold. So we really like, sort of that validation that you actually have landed, a few customers, that you got a bit of that product market fit, that we can sort of be more speed up capital, that we can sort of help you come in, sort of figure out what's working and sort of put more dollars behind that to help build out the team and sort of, go after that market more aggressively. So really sort of team, TAM, and traction, I would say, are sort of the 3 buckets that we're really trying to sort of dial in there on the first call.
Love it. Okay. So then 20% of them make it to call number 2. Talk me through that one.
Yeah. And again, it's really hard. It's a hard part of the job. I wouldn't say that 80% of the folks, are underwhelming. I mean, if anything, 80% are sort of very impressive. But we have to pick our spots, right? There's a lot of opportunity cost for us, and we certainly don't get them all right. But we're really, at any given point in time, there's probably 10 deals that we're looking at. We're trying to sort of figure out what's sort of sitting at the top of the board and what's middle of the pack and lower. And as I said,
I'm sorry to keep interrupting you, but there's just a couple of things that are occurring to me that are just super interesting based on your earlier story. So that discipline that you have now, that you're managing $100 million fund, and which part of that discipline, I'm sure, also comes because you're treating it like somebody else's money, right? You have discipline around the way that you're approaching it. Contrast that to all the way back in 2010 when you were just getting started with angel investing. Did you still have that same discipline back then? Or is that something you had to develop over time? When you first started, did you want to invest in every deal, or did you already at that time have the discipline to say, nope, I know how the numbers work here. I need to run a process. I'm only going to invest in deals that fit this kind of criteria. What's different between now and then?
Yeah, no, look, I often think about how sort of my investing sort of methodologies have changed, over the years. And if I had to go back to 2010, I would say, that very first deal was very much sort of, if I had to distill it down as, bet the jockey, not the horse, right? You probably heard that term, and try to find the best entrepreneurs I could, and, not give, quite as much, thought to how good the horse might be. I'd say where I've come out is that a great jockey, the best of jockeys, can build businesses. You see it all the time. Folks probably in your community that build, business worth $50, $100 million. But, as I've touched on before, if you're really going to try to crack the code and build something that's going to be worth billions of dollars, frankly, you've got to have a great jockey and a great horse. And I'd say, that the evolution for me has been to recognize that it's very multifaceted when you think about, what has to work, what has to sort of come together here. So you got to have certainly a fantastic jockey, to use that parlance, but you also have to have just a fantastic horse. And so we're really trying to look, to solve for both of those. And it's difficult. We try to do a meaningful amount of diligence. We try to be sort of as analytical as we can about this at the early stages. That can be, frankly, quite difficult. But we do try to, sort of really run it through a bit of a sort of, programmatic sort of set of, sort of models that we build over time. What works, what doesn't, and try to sort of score these opportunities as well as we can. Again, it's still very much a work in process. I think that, we constantly evolve here and adapt.
Got it. Thank you. Appreciate that.
Sure.
This episode is brought to you by Full Stack PEO. Most founders start companies because they figured out a better way to solve a problem or serve a need, not because they love tracking payroll, filling out compliance forms, and explaining employee benefits packages. And yet, all that stuff still has to be done. That's why there's Full Stack PEO. Full Stack PEO specializes in turnkey HR for emerging companies, not just those core services, but advice and expertise that help founders maximize employee potential. Curious? Find out more at fullstackpeo.com.
So let's keep going down that journey for the entrepreneur. So second screening call, what's happening there?
Yeah, at that point, it might be me or one of my colleagues that have done the first call. Usually just going to be one of us on the phone for the first one. By the second call, you're probably going to get, the entirety of the firm, or if not, close to it. As I said before, constantly trying to be mindful and respectful of the entrepreneur's time. So to the extent that you've, sort of made it through the email screen and the first call screen, it's something that we're heavily considering by the second call. So we will come into that with, sort of more specific line of questioning that'll speak to sort of the product and the market and sort of what's differentiated and whatnot, and sort of trying to, sort of come at it from multiple different angles. And, my colleagues and I, we're of different backgrounds, and, I think a lot of us sort of attack things from different angles. So that's probably going to be about an hour. We will have tried to sort of gotten up the curve a bit, in advance of that call, to know a little bit more about the competitive landscape, to sort of really spend time with the deck and, and sort of what's going on in that market. And assuming that call goes well, pre-COVID, we would have, been inviting that entrepreneur and probably some other members of the senior leadership team into our office. Again, we would have been doing, a meaningful amount of diligence between, sort of the second call and that meeting. If the in-office meeting or today, sort of the third meeting is also going to be on Zoom. If that goes well, we are probably at that point, starting to talk to the other key employees. We're probably starting to ask to speak to some customers to better understand sort of how they, have been working, with the respective company, how they see the competitive landscape. We're probably, doing a lot of other work sort of on the backside, maybe even, hiring, some folks that if we don't have a lot of in-depth knowledge, we've engaged some consultants from time to time to sort of help us ramp up. And, it's not going to be something that we spend an inordinate amount of time on, but just to sort of get the perspectives of people that have been living in that industry. Again, given that we're agnostic, we feel like we can get up the learning curve pretty quickly. There's very much sort of the law of diminishing returns here. I think once you sort of know 80% of the market, to get to 85 is probably starting to push whether or not it's going to be worth it. But start to finish, Mike, on all that, in many cases we can get that term sheet in under 3 weeks. And again, something we really sort of pride ourselves on is being fast and efficient. You really get, we're a small team. Everybody's got a voice. We act with, sort of unanimity on the way that we sort of proceed against these things, and kind of all, really lock arms and try to work as hard as we can, as fast as we can, upon meeting that great entrepreneur and great company.
Awesome. Thank you. Do you have any sort of preference on deal structure or kind of trends with how deals are structured? So specifically asking about safe notes, convertible debt, equity, any thoughts or comments there?
Yeah. We typically prefer priced rounds, just because, we've done safes, we've done converts, to the extent we're going to do those, we like sort of the cap to be reflective of what we think fair market value is today. We don't, sort of like walking into a deal with, sort of a cap that we feel like is sort of out of, today's sort of valuation range, because as I mentioned before, we run sort of much more sort of high conviction concentrated portfolios where we're working really, really hard on behalf of those companies, doing all we can to drive value. And to the extent that we already have sort of our share price, if you will, a lot of times we're sort of working against ourselves, right? Driving that valuation higher that we'll ultimately convert into if we're just sitting in a safe or a convert. So we do have a strong preference for priced rounds. Again, given we usually lead deals and we're usually sort of investing in rounds that are going to be $3 to $5 million. Most of those are of a stage, where they're being priced anyway. But certainly there are exceptions out there.
And any other kind of from a deal company structure perspective, any other kind of requirements? Like it's always got to be a C Corp. It's always got to look like this or look like that. Anything else you would rattle off really quick?
Great question. So back in our earliest days, we invested in LLC. There's just some administrative sort of burdens that come with that when you're managing the fund. We've got, across our two funds, we've got, well over 100 investors. And an LLC, right? You've got a K1 each year, so that becomes a bit unwieldy. So today we absolutely only invest in corporations. I believe all have been Delaware corporations. It's just, Mike, you probably experienced this as well. Just sort of the case law and just, the documentation and all is really sort of aligned to be in those Delaware C Corps. So almost in every instance, that's what we're seeing today. We invest always in preferred stock, so we won't ever sort of invest in common. I think that's pretty standard, sort of across the venture landscape that folks are buying preferred stock. We try to be very fair, so we're not investing in participating preferred, or there's sort of no heavy liquidation preferences. Just trying to be sort of very standard. If you look at our documentation, it almost always follows the NVCA docs, which are just sort of the industry norm. And what most sort of law firms are going to start with, if we've done safes, it's the Y Combinator safe. We try to sort of stay very, very much on market with respect to terms.
If somebody shows up with a tax credit for their state, assuming it's transferable and you actually get a chance to take advantage of it, does that matter at all, or is that just a nice to have if it's there? It's
a nice to have. Again, end of the day, it's not going to be too determinative of how ultimately successful companies are going to be. But we've got a couple of companies that are based out of Canada, and they've had some nice sort of incentives from the government. We definitely leverage that. To the extent that there's sort of capital available that's not going to be dilutive. It's something that we absolutely focus on and see the benefit of. Right on.
So when somebody comes in to do that pitch, or historically with their team, or if today it's in a Zoom call, and you're going through the process, what are some of the things that they're not saying that you're looking for? Like, because to me, one of the things that's really interesting there, particularly when you get them either in a room or out to dinner with the rest of the team, there's a lot more you can see about, dynamics and how they interact. I'd love your thoughts on that.
Most of the time, you're going to have co-founders, right? So we obviously invested in sort of single founder companies, but in many cases there are going to be two or three sort of individuals that sort of have sort of the founder title. You touched on this, but we'd like to see that dynamic and sort of how they sort of allocate responsibilities, how they work together, what's the depth of their relationship. Back to that mercenary versus missionary point, we recognize that sort of folks that have worked together for a long time, that there's a lot of mutual respect. It works a lot better than people that have sort of come together, just out of necessity. So that's something we're going to be looking at. I'll also try to do what we call sort of pre-mortems, right? And that, if this thing fails, what's likely to be the culprit? That's one of the ways that we sort of like to invert things and think about what can go wrong, what's most likely to go wrong. And a lot of times, entrepreneurs haven't really thought through that. And you can sort of see that, when you ask that question, they often sort of struggle. And that's, I think it's because, entrepreneurs are generally optimistic by nature, right? Otherwise they wouldn't be sort of wading into this difficult arena. But we really like to sort of have them, sort of think through what's likely to go wrong. Because I think once you identify that, you can try to sort of navigate around it. But those dynamics are just incredibly important. Like I said, is there real leadership? Does there seem to be sort of a lot of respect for that leader? Does it feel like that they sort of check the egos at the door, that there's not somebody that is got sort of an ego that could get in the way of success, or just sort of working collaboratively with the team. So those are all things that we're trying to solve for in those meetings. And frankly, it's increasingly difficult over Zoom because you don't have the ability to read the body language and some of that. We are where we are. We've had to adapt.
I'm fascinated by the idea of running a pre-mortem. I now want to do that for a couple of companies. That sounds like a lot of fun. What are some of the most common things that are coming up in pre-mortems? I mean, I'm assuming, like market timing, sales, like there's obviously some running out of capital things that you would imagine would come up pretty quick from the founders. How do you get them to the deeper issues?
Yeah. It's, it varies by company. A lot of it is, frankly, folks aren't thinking through unit economics perhaps as deeply as they should. They've got this vision, and they think that, well, if we build it, folks will come and they'll pay the amounts for it that we need to survive. But when you really start to peel back the onion, you think about customer acquisition cost, and do you have network effects, or is there recurring revenue, or kind of when you really start to kind of drill down into this, you often find that sort of lifetime value of the customer relative to customer acquisition costs can just be upside down, or at least sort of be in a ratio that's just not sort of compelling to build a valuable business. That's one that you often find some folks sort of start to fall down on. Competitive landscape as well. I mean, you use Amazon as an example. If Amazon wants to come into a market, it's not uncommon for them to run negative gross margins. And while you can never sort of fully predict, how that landscape's going to evolve, we do like to be thoughtful around, who are sort of the logical competitors. One of the things that we've historically liked, and I mentioned fintech and healthcare and prop tech, all are sort of massive markets, in many cases with sort of incumbents that haven't been all that sort of forward thinking. And what we found that often works is just to come in and try to take just a small slice of that pie, come in with a really narrow wedge, but ultimately start to pry that open. So we like to be really methodical about is there some pain point that we can solve for a customer that sort of gets us access, and we can sort of build the company's reputation, that we can get people to sort of pay a fair price for that, and sort of given what it costs to build that product and acquire that customer is going to have sort of compelling margin profile. We sort of often love to start there, and then see if we can't sort of break it open a little bit farther down the line.
When you reflect back on your 10 plus years of investing, what are some of the biggest mistakes you've made? It's
One I would say is, don't go it alone. The old saying, it takes a village. So, I mentioned earlier in the call that we usually like to take about half the round, and then we like to pull a syndicate, alongside us. That I would say is a lesson that we've learned. There were some deals that we did, early in our careers where we were taking, the all or the majority of a round. And, what you find is, when things start to go sideways or sort of not go as planned, it might be that there's another member of the syndicate that's got an experience or an insight that sort of helps get things on a better path. Second to that, oftentimes you might find yourself in a position where you need to sort of bridge things out because, for whatever reason, you just haven't been able to generate the revenue sort of on the timeline that you might have expected. You're not quite ready to raise that Series A yet. And to be able to sort of pass the hat to put another couple $1 million into the company. Whereas, if you go it alone, you're sort of looking to do that on your own. We think that's important. So we try to be really thoughtful about that syndicate. As I mentioned before, that mercenary missionary point has been one that we've learned. We've done some deals where I think, perhaps the entrepreneur was a little bit more mercenary. They were coming into it because they thought they might be able to make a quick buck. And when the going gets tough, it just those folks are sort of more inclined to fold, relative to the people that, like I said, just have that burning passion that are going to just keep walking through that wall, every day. And a lot of times, you do have to knock your head against the wall several times before you finally start to crack it, sort of figure out what works. So we love the folks that are willing to stay in the game. Those businesses that have an ability to be capital efficient early on until you really do have that product market fit, we think is also important. So I'd say those are some of the most important lessons that we've learned thus far.
And then hit me with maybe a couple of the bright spots. What are some of the things that either you and the team stumbled into or moments where maybe you got lucky, but you're trying to find the lesson in that so you can recreate that luck more often than not? What jumps out to you when I ask that?
Yeah, Mike, it might sound funny, but we've got several companies now worth, hundreds of millions of dollars. And when we look back, it was the exceptional nature of those entrepreneurs was obvious from the very first meeting. And, look, I think nearly all of the entrepreneurs in our portfolio are very, very exceptional, but, there are always, a few that sort of stand out from the rest. And I would say when you look at our portfolio, the companies that are, on their path to being unicorns, or, some of them haven't raised money, recently, but I think probably already are unicorns. The entrepreneurs are just really incredible. I mean, they're incredibly bright. They have, very, very sort of unique visions. They have recruited incredible teams around them. So sort of going back to that charisma point, that I made earlier. So, I don't mean to say you know it when you know it, but there is a little bit of that component to it. And as early as we're investing, I mean, frankly, a lot of the framework is it's not so much, trying to determine whether or not that company will succeed, but whether or not that individual will succeed. And so I think that's something that's certainly been a common thread is just, folks that are just really, really exceptional. Second to that, I would say we really like trying to invest between sort of durable tailwinds, right? So when you see these thematic shifts in society, whether it be, healthy foods or, doing good is good business, just people trying to sort of be thoughtful for all stakeholders in a business. I think, we see that, that actually, has worked well for us also. We're not an impact fund, but we absolutely like to invest in those businesses that we feel like, sort of mission aligned and sort of doing good for the planet, doing good for a customer, underserved community, whatever that might be, because I think they are recruiting talent at a higher clip. Customer acquisition costs are typically low, just less attrition throughout the ranks. And, again, just folks that are really excited about sort of coming into the office every day and sort of, trying to build the service or product, has been important. So those are some lessons that we've learned and continue to try to, lean on, looking at new investments today.
I'm struggling to reconcile. So by the way, thank you for that. Those are awesome answers. That's not what I'm struggling with. I'm struggling to reconcile your first answer there, right? Which is, you've been lucky enough to find some, amazing individuals that you can invest in, and kind of like you said, when you see it in your process, it's 3 meetings. It's a couple of phone calls, and then previously would have been a face-to-face. Now, a Zoom session. how are you getting to that depth of determination, whether it's in, raw computing power, character, passion, all of those things that are coming together? Like, man, I'm just super intrigued at what you and the team are looking at and seeing in those 3 meetings that can translate that strongly into a buy or sell decision.
Yeah. And Mike, I probably misspoke on the 3 meetings. What's going to happen is we usually have a very, very strong opinion on a company by that 3rd meeting. I would say that, we probably met with an entrepreneur, plus or minus at least 5 times before, term sheets actually signed, days, come by, one of those could have been just, going out for a beer or a coffee. Again, not even talking about the business, just, trying to understand, is there good personal rapport, between us, recognizing that we're going to be working a lot with those folks. But, we're also, we're talking to folks in the community. So we're validating sort of our impressions by either sort of where that deal came from. Not a lot sort of gets, to that first call that's just going to be totally a cold inbound. We've worked really hard on sourcing channels and you sort of validating, entrepreneurs and sort of business models even before they get to us by people that we trust. The entrepreneur community, frankly, is pretty small. And so in almost all the cities, we're investing in about half the capital we've deployed. It's actually been outside of New York City and in some markets that are, often off the radar. We invested in Huntsville, Alabama, and Richmond, Virginia, and Greensboro, North Carolina, of all places. But, we're trying to do a lot of work, as well, trying to get the people. LinkedIn's a great tool, and that, you can see that, hey, we're linked with 10 people. We're probably talking to all 10 about, hey, what do you think about Mike, right? Is he as exceptional as we think he is, right? So there's a lot of that being done. It's not that, yes, we definitely trust our gut immensely, but, at the same time, we're going to be doing, a lot of sort of back channeling to make sure that we can validate that.
I love that answer. Thank you. That's awesome. I'm glad I asked. So in there, you mentioned sourcing channels. I'd love to maybe pick at that for a minute, if you let me. Talk to me a little bit about where deal flow comes from. How do you do that?
Yeah. So, this is a, venture is a business with I think a pretty big flywheel, right? So as I mentioned, that entrepreneur community is fairly small, and there's a reason that the Sequoias and the Benchmarks and the Bessemers of the world continue to see a lot of fantastic sort of deal flow. It's because they've invested in a lot of fantastic deals, and those entrepreneurs have influences on the entrepreneur community, and so people can quickly look and say, all right, well, who led this guy or gal's deal? I want to go try to speak with them as well. So I think the longer you've been at this, it's just generally sort of the more your reputation starts to precede you. We work really, really hard on trying to, sort of be an incredible partner to those entrepreneurs, to make sure that when they're sort of advising folks or sort of trying to give back to that entrepreneur community, and folks are saying, hey, who should I talk to about, leading my seed round? That Third Prime is, if not sort of the first one off the tip of the tongue, certainly part of that conversation. So, we work really hard to sort of cultivate entrepreneurs to be our champions. That's one. We also, again, recognizing that we aren't, going to be taking the entirety of the round. We've built very strong relationships with a lot of other venture capitalists, especially those that might be a bit upstream, sort of investing, in sort of pre-seed rounds, and they're thinking about, well, who could be our, the best partner for the seed round. That's been a good channel for us. Investing in those relationships with those firms that don't lead rounds, but just like to participate. There are a lot of those firms out there as well. Certainly, it's very symbiotic for them to kick deals over to us that they're excited about, and that company still might be looking for a lead. That works very, very well. We also try to build relationships with incubators and accelerators. A lot of these communities that I said are sort of in these emerging geographies, like Nashville, Tennessee, or Austin. Austin's not so emerging anymore, but we try to get to know the angel investors in these communities. The folks that are meeting with the entrepreneurs very, very early, and like I said, the accelerators, the incubators. A lot of times schools have programs. Trying to really sort of put boots on the ground and sort of wave the Third Prime flag, in those communities to make sure that when folks are looking to raise money or just want to sort of get some advice, that they recognize that Third Prime's out there. So it's a bit of sort of, like I said, having boots on the ground in some of these communities, really trying to sort of work, our relationships and prove, to be, just fantastic partners for folks.
Awesome. And then if somebody shows up, and I'm not looking for names here, but I am actually curious. If somebody shows up and they already have another investor who has made a commitment, is there anybody on that list who would be like a red flag for you, where you would say, if they're investing, maybe we're not a good fit?
I wouldn't say so much a red flag. Usually what's going to happen is, they might have, all right, look, we're trying to raise $3 million and we've got sort of $1 million of, sort of spoken for here, but nobody that's come in and sort of, setting the terms, sort of figuring out what the valuation is going to be and sort of what, kind of what, governance provisions are going to look like and whatnot for that security. So we're typically sort of seeing a lot of those deals, where, they've got some interest, they just don't have a lead. We have done co-lead deals where, that there is somebody that's actually negotiated the terms and, taken a meaningful amount of the round, but there's still a meaningful slug left. And, we can still get 10% of the company or something, which is sort of an ownership target that we like to, sort of do our best to satisfy. But I wouldn't, let me put it this way. I wouldn't say that there's anybody that if we see is going to be a part of the cap table that we're saying, all right, no way are we going to touch that. That being said, I'm not going to name names, but there are absolutely parties that we enjoy working with, that we have immense respect for, and to the extent that we see them, sort of coming into a syndicate, it certainly can have a positive influence.
Awesome, love hearing that. I don't think 10% is uncommon. I hear that number a lot. Why 10%? Why is that the equity target?
Yeah, for us, again, we recognize that we're going to be spending a lot of time, with these respective companies. And, it's sort of when you do that venture math and you recognize, all right, well, we're trying to, get back 3 to 4x net, to our investors over the life of this fund. And you start, sort of working backwards, like, all right, well, how many companies actually sell for $1 billion? Not many, right? To be honest, that's what, we're trying to underwrite to, but, most are going to sell in hundreds of millions of dollars, and some of them won't work out at all. So you sort of, again, kind of do that portfolio math and recognize, all right, well, if a company sells for $200 million, probably even taking dilution from that 10%, to get there. And let's just say we're going to own 7% of that, by the time of exit, that's going to be, just $14 million back to us. We worked really hard on it. Sort of what's the cash on cash multiple, and just recognizing really the driver is, sort of putting our time behind where our ownership is. And, we've sort of made, I don't necessarily call it a mistake, because we've obviously enjoyed working with the entrepreneurs and trying to be helpful. But, early in our days, we were sort of, finding some companies we thought were really exciting. We put a check in, we own, 1 or 2%. And even if they have, a pretty nice outcome, sort of the payday, frankly, for us, it's not that big of a check. So we really try to concentrate both our capital and time. And when I say concentrate capital, attendant with that is just, having some meaningful ownership.
Perfect. All right, Wes, I am truly enjoying this. I'm positive I could talk to you for another hour, but I think I've already kept you longer than I was supposed to. So let's call this a good stopping point for now. If folks want to get in touch with you, what's the best way for them to do that?
Yeah, they can find me on Twitter at farmer_VC. Go
yes.
the farmer turned VC. And then, you can find us, on the website as well. It's thirdprime.vc, and you can catch me at just Wes at thirdprime.vc on the email.
Awesome. Well, I really appreciate it. Thank you so much for taking the time.
Great. Enjoyed it. Thanks for having me.
If you're thinking of launching a SaaS product, Startup Competitors can provide data on your closest competitors, survey potential users, or provide other product validation services. Learn more at startupcompetitors.com.